Hi everybody, Thomas here. If you spend any time trying to invest in the stock market on your own using mutual funds, individual stocks, or stock options, it's likely that more than once you found yourself wondering why it's so hard. The real irony is that success in the market is often less about what the wealthiest 1% are doing than it is about what they aren't doing. These investors have had to learn, usually through hard-earned and costly experience, how to eliminate habits and tendencies that come naturally to all of us. Many of these habits come from lack of experience and knowledge, but in most cases they simply come from the limitations of human nature. In this video, I'm going to talk about 4 of the biggest mistakes the average investor makes over and over again, usually without even knowing it. If you can identify and understand these mistakes, you can start looking out for them and develop your own plan for how to eliminate them from your own investing system. With more than 15,000 stocks available on stock exchanges or over the counter in the US, how do you decide what stock you should buy at any given time? Most of us don't have access to the sophisticated screening tools and systems used by institutional investors and mutual funds to identify investing opportunities. Instead, we have to rely on simpler sources. That usually means paying attention to news media outlets like Bloomberg, Yahoo Finance, MSNBC, or CNBC, who use popular experts to talk about the stock market. You can also rely on the advice of friends, colleagues, and other associates you know that invest in the market. The problem is that whether you're paying attention to a talking head on television or to a friend, the best opportunity in the stocks that they're going to talk about will usually have already occurred. Everybody else was already late to the party, and that means that the best opportunities are in the past. The real irony is that the vast majority of investors rely really on nothing more reliable than one of these 2 sources to make their investing decisions. That's why I call this mistake following the herd. You buy a stock because everybody else seems to be doing the exact same thing. The real truth, however, is that history has proven that when everybody else begins buying a stock, that's usually where its latest upward surge ends. Inevitably, everyday investors, like you and me, are the ones that end up losing the most when the inevitable downward reversal comes. Do you consider yourself a bargain shopper? Do you clip coupons before you buy groceries? When you shop for clothes, do you head straight for the clearance rack before you look at anything else? Are you the type of person that always tries to talk salespeople into a lower price than what's listed before you make a buying decision? For a lot of people, the automatic answer to these questions is yes, because doing anything else just simply doesn't make sense. Why pay full price for something when you can get the same thing or very nearly the same thing for a lot less? The ironic thing is that while few of us would argue with the logic of bargain hunting when it comes to retail goods, the average investor generally fails to apply the same mindset to the stock market. Even more experienced investors often don't factor whether a stock's price provides a bargain proposition into their analysis and decision making. It's like walking into a department store and just going to the latest stock clothing without even glancing at the clearance rack at all. Just doesn't make sense. The truth is that you can improve or decrease your individual chances of seeing the market's inevitable swings from high to low and back again work in your favor if you're willing to consider where a stock's price is compared to where it's been. It's a proven fact that all trends come to an end and reverse in the opposite direction. And that means that recognizing stocks at or near extreme lows is a good place to start putting the odds in your favor. We've all had it happen at one point or another. That old buddy who comes to visit and just doesn't know when it's time to leave. You hem and you haw. You try to drop hints, but he just doesn't get it. Finally, you have to make a choice. You can either tell him bluntly that he's got to go home, or you can go make up the guest bed for him. When it comes to investing, the ironic truth is that often that unwelcome visitor who simply fails to realize when the time to go away has come is you. Average investors fall into this trap all the time, fed by talking heads on TV and the internet who praise a company for no other reason than the fact that the stock price has been going up. Keep in mind, holding a stock too long is something that has happened and will keep happening at some point to just about any new investor. It's even happened to the wealthy 1% elite. If it's already happened to you, it doesn't mean you're a loser or doomed to fail as an investor. It just means that you're like everybody else. What distinguishes elite investors from all the rest is that they learned how to use that experience to learn how to make sure they get out when the market starts to turn against them. One of the big keys is learning to separate your emotions from your investments so you can cut bait from a trade, win or lose, without the emotional baggage that everybody else is dealing with. It means learning how to manage your trades so that when you are profitable, in the long run, you'll be able to hold on to most of your gains. One of the biggest mistakes investors fall prey to is failing to analyze correctly how much money they should put into an investment and then follow through with a deliberate plan to manage those trades on a daily basis. When you find a stock you think is just too good to pass up, it's tempting to put everything you can stand to risk into the trade so you can maximize the expected profit as much as possible. This is a natural but incorrect mindset. It's forced more beginning investors out of the market than any other single mistake they could have made. I call it playing with monopoly money because too often investors choose to follow the bad advice of market media and investment advisors to take a long-term view and ride through the market's ups and downs. It makes them start treating their hard-earned investing capital as little more than paper money used to buy fake property on a board game. Correcting this mistake starts by incorporating a conservative system of money management into your investments. The simple reality is that a sound approach in this area is going to contribute more to your long-term investing success than any single investing method or strategy. If you're new to the market, that might sound a little strange, but the truth is there is no perfect investing system. The simple fact is every system will encounter losing trades. In fact, even the wealthiest and most successful investors in the world have learned to expect to lose money on 60 to 70% of the trades that they make. Their ability to limit the losses on those losing trades is what enables the winning trades to turn a net profit in the long run. Now that you know what the 4 biggest mistakes the top 1% of investors don't make are, you can start to think not only about how you can minimize these mistakes in your own investing system, but even more importantly, how you can flip the pattern and turn these negative behaviors into positive behaviors that can give you an advantage over the rest of the market. If you want to learn how to turn these 4 mistakes into major advantages, check out this video. You can also click here to subscribe to this channel and get notifications for every new video I add. If you'd like to see my weekly trades, you can sign up for my trading alerts using the link in the description area of this video. Thanks for your time. I'm Thomas at Rebel Income. Talk to you again soon.